Same shopping cart, same 5 items, but in 2019, it cost $18. Today, it costs $34. That's almost double for the exact same groceries. Your salary might have gone up a little, but have you ever noticed that somehow money just doesn't go as far as it used to? That new car seems unaffordable. That house you could have bought 5 years ago is now way out of reach. Your savings account has more dollars in it than ever, but somehow it buys less. This isn't bad luck, it's not your imagination, it's inflation. And today, I'm going to show you exactly what inflation is, how it quietly steals your wealth every single year, and most importantly, the specific steps you can take to protect yourself and actually profit from it. By the end of this video, you'll understand exactly what inflation is and where it comes from, the specific math showing how much wealth inflation is quietly stealing from you right now, why keeping money in a savings account is actually losing money in real terms, the 3 biggest mistakes people make because they don't understand inflation, and the exact investments that historically protect and grow your wealth during inflationary periods. I've been investing for over 10 years, and understanding inflation changed everything about how I think about money. Let's build that foundation. Quick disclaimer. Everything I share is purely educational based on my personal experience and research. I am not a licensed financial advisor, and nothing I share is financial advice. The inflation figures I use are for illustration and may not reflect current rates in your specific country. Always verify current data and consult qualified financial professionals for your specific situation. Now, let's understand inflation. Let me explain inflation as simply as possible. Imagine an economy with 5 people and 5 loaves of bread. Each person has $1. Bread costs $1. Everyone can buy 1 loaf. Now the government prints more money and gives everyone an extra $1. Now everyone has $2. But here's the thing, there are still only 5 loaves of bread. The baker sees everyone has more money and raises the price to $2 per loaf. Everyone still only gets 1 loaf, but now it costs twice as much. Your $2 buy exactly what your $1 bought before. That's inflation in its simplest form. Too many dollars chasing too few goods. The money supply expands faster than the supply of goods and services, so each individual dollar becomes less valuable. The official definition, inflation is the sustained increase in the general price level of goods and services in an economy, or equivalently, the decline in purchasing power of money over time. Inflation comes from 3 main sources. First, demand pull inflation. This happens when too much money is chasing too few goods. After COVID, governments gave out enormous stimulus payments. People had more money to spend, but supply chains were broken and goods were scarce. Result, massive inflation globally. Second, cost push inflation. When the cost of producing goods rises, businesses pass that cost to consumers. Energy prices rise, oil gets more expensive, which makes manufacturing, transport, and almost everything more expensive. This pushes prices up from the supply side. Third, and most important to understand, monetary inflation. When central banks and governments print significantly more money without a corresponding increase in goods and services, each unit of currency becomes less valuable. The U.S. roughly doubled its money supply between 2020 and 2021 in response to COVID. The resulting inflation wave was the largest in 4 decades. In practice, major inflation events involve all 3 causes happening at once. But monetary inflation, the expansion of the money supply, is the root cause that amplifies the others. Let me show you the math that most people never sit down to calculate because it's genuinely shocking. You save $10,000. You feel good about this. You put it in a regular savings account or under your mattress. Inflation runs at 3% per year, which has historically been around the global average. After 10 years, your $10,000 nominally still says $10,000, but in real purchasing power, after accounting for inflation, it's now worth about $7,300. After 20 years, about $5,400. After 30 years, just over $4,000. You literally lost nearly $6,000 in purchasing power without spending a single cent, just by letting inflation silently erode your money's value year after year. Here's a useful tool called the Rule of 72.
Take 72 and divide it by the inflation rate. The result is roughly how many years it takes for inflation to cut your money in half. At 3% inflation, your money halves in 24 years. At 7% inflation, which several countries experienced in 2022 and 2023, your money halves in just 10 years. This is why saving money without investing it is, in real terms, losing money. Here's the savings illusion. Your bank shows you 4.5% interest. You feel like your money is growing. But look at what's actually happening. Inflation is running at 3.5%. Your real return, the return that actually matters, is 4.5 minus 3.5, which is just 1%. Your $10,000 grew by $450 nominally, but in real purchasing power after accounting for inflation, you only gained about $100. And if your interest income is taxed, which it is in most countries, your after-tax nominal return might be just 3.3%, which is below inflation. You're actually losing real purchasing power, while your bank statement tells you that you're earning. For most of the decade between 2010 and 2021, interest rates on savings accounts were between 0 and 2%, while inflation ran higher. Millions of people had their wealth slowly eroded while thinking they were being financially responsible. This is the savings account illusion. Nominal returns feel good. Real returns tell the truth.
Here's something most people don't realize. Inflation doesn't affect everyone equally. Some people actually benefit from inflation, while others get devastated by it. The losers of inflation are people who hold cash or savings because their purchasing power erodes every year. Fixed salaried workers whose raises don't keep pace with inflation are effectively taking a pay cut in real terms. And retirees on fixed pensions who watch their monthly payments buy less and less every single year. The winners of inflation are real estate owners because property values and rental incomes tend to rise with inflation while the mortgage stays fixed in nominal terms. Equity investors and companies that can raise their prices, meaning their revenues grow with inflation. And somewhat counterintuitively, borrowers with fixed-rate debt because they pay back their loans with dollars that are worth less than when they borrowed them. The key insight that separates these two groups is what they own. Cash holders get poorer. Asset owners get richer. This is why understanding inflation is inseparable from understanding why investing matters. The wealthy own assets that rise with inflation. Everyone else holds cash that falls. Understanding inflation also means understanding the 3 most expensive mistakes people make because of it. Mistake 1. Keeping too much cash sitting safely in a savings account. If you keep $50,000 in cash for 10 years with 3% inflation, you've lost over $12,000 in real purchasing power without spending a single cent. The vault feels safe. Inflation is invisible, but the theft is real. Fix. Keep only 3 to 6 months of expenses as a cash emergency fund. Invest everything else. Mistake 2. Getting a raise is confusing getting wealth. If you get a 6% raise, but inflation is running at 7%, your real purchasing power actually decreased by 1%. You're making more dollars that buy less. Fix. Negotiate raises that beat inflation and invest the difference so your money actually grows. Mistake 3. Planning retirement without accounting for inflation. $500,000 today might feel like enough for retirement, but in 20 years at 3% inflation, that $500,000 has the purchasing power of only $277,000 in today's terms. Fix. Multiply your retirement target by at least 1.5 to 2 times to account for the inflation erosion that will happen between now and when you need the money. How is inflation officially measured? The most common measure is the Consumer Price Index, or CPI. Government statisticians track the prices of a representative basket of goods and services that a typical household buys. Housing and rent represent about 33% of the basket, food and beverages about 14%, transportation 16%, medical care 8%, education 6%, and other categories making up the rest. Each month, they compare prices to the previous period and calculate the percentage change. That's the official inflation number you hear on the news.
but the CPI has real limitations. It might not reflect your personal spending pattern. Housing in the CPI often understates real rental increases. Different life situations have different personal inflation rates. A retiree spending heavily on healthcare faces very different inflation than a young renter. The key takeaway: the official inflation number is a useful guide, but your personal inflation may be noticeably higher. Track your own spending to understand your real inflation rate. So what actually beats inflation? Here are the 5 main categories with honest assessments. First, stocks and equity ETFs. Historically, the best long-term inflation beater. The S&P 500 has averaged about 10% annually. Subtract 3% average inflation, and you have roughly 7% real return per year. Companies can raise their prices during inflation, which grows their revenue and ultimately grows your investment value. ETFs like VOO, VTI, and SPY give you this exposure easily. Second, real estate. Property values and rental income both tend to rise with inflation, and if you have a fixed-rate mortgage, that debt becomes cheaper in real terms over time as inflation erodes its real value. REITs give you real estate exposure without buying property and typically yield 4 to 7%. Third, gold and commodities. Gold has been used as an inflation hedge for centuries. During high inflation periods, gold has historically preserved purchasing power. It doesn't generate income, but maintains value. Fourth, TIPS, Treasury Inflation-Protected Securities. These are government bonds where the principal automatically adjusts with the inflation index. The real return is small, but guaranteed above inflation with government backing. Fifth, Bitcoin. Some investors view it as digital gold with its fixed supply providing an inflation hedge, but it's extremely volatile and speculative. If you use it at all, keep it at 1 to 5% of your portfolio. The overall ranking for inflation protection: stocks for long-term, real estate for stability, gold for tradition, TIPS for safety, Bitcoin for speculation.
Let me show you the actual numbers from 2000 to 2024 comparing major asset classes against inflation. U.S. stocks in the S&P 500 averaged about 10.5% annually in nominal terms, which translates to roughly 7.5% in real inflation-adjusted terms. Clear winner. Real estate averaged about 8.5% nominally, 5.5% real. Strong performer. Gold averaged around 8% nominally, 5% real. A solid inflation hedge. But here's the most revealing number. U.S. savings accounts averaged about 1.5% annually over this period, while inflation averaged about 3%. Real return, negative 1.5%. Savings account holders were in the wealth-destroying zone every single year for most of the past 2 decades, thinking they were being safe and responsible. There's a clear dividing line between assets that grow your wealth in real terms and assets that appear safe but actually destroy it. Equities and real assets are consistently above this line. Cash savings are consistently below it. This is the single most important visual in understanding why investing isn't just about getting rich, it's about not getting poorer. Here's your practical personal inflation protection framework built as a pyramid. The foundation: keep 3 to 6 months of expenses in a high-yield savings account, getting as close to the inflation rate as possible. This is your emergency fund. After that, every extra dollar of cash beyond monthly expenses should be working harder. Second layer, your core wealth engine. 40 to 60% of your investable money in broad market ETFs. Set up automatic monthly dollar cost averaging. Historically, this layer delivers 7% or more in real returns, significantly beating inflation. Third layer, inflation-specific assets. 20 to 30% in real estate through REITs like VNQ and O, plus a small allocation to gold through GLD or similar. These assets tend to rise directly with inflation, providing additional protection when inflation spikes. Fourth layer, the optional peak, 0 to 10% in speculative assets like Bitcoin if you understand the extreme risk and can afford to lose it. For a moderate investor, a sample allocation might look like emergency fund in high-yield savings, 50% in broad ETFs, 25% in REITs and real estate,
15% in dividend stocks, 5% in gold, and 5% optional Bitcoin. With this framework, rising inflation actually works in your favor rather than against you because your assets rise with it. Here are your 6 concrete action steps to protect yourself from inflation starting this week. Action 1. If your emergency fund is in a regular savings account paying under 1%, move it to a high-yield savings account. Many banks and online institutions offer 4 to 5% currently. This single move could earn you hundreds of extra dollars per year on your emergency fund alone. Action 2. Set up automatic monthly ETF investing through a brokerage account. Even $50 to $100 per month in VOO or VTI starts the wealth-building engine that historically outpaces inflation significantly. Action 3. Add REIT exposure to your portfolio through VNQ or realty income for real estate inflation protection without the complexity of buying property. Action 4. At your next performance review or salary negotiation, remember that a raise below inflation is a real pay cut. Negotiate with inflation data in hand. Action 5. Revisit your retirement calculations and multiply your target by at least 1.5 to 2 times to account for 20 to 30 years of inflation between now and retirement. Action 6. Start tracking your personal inflation rate monthly. Compare what you spent this month versus the same month last year. Your personal inflation rate may differ significantly from the official CPI, and understanding it helps you plan accurately. Let's bring everything together. The problem? Inflation silently erodes your money's purchasing power every single year. $10,000 today has only $4,000 of real purchasing power in 30 years at 3% inflation. Regular savings accounts don't keep up, meaning they generate real losses. Fixed salaries lose real purchasing power if raises don't beat inflation, and most people are dramatically underestimating their retirement needs by ignoring inflation. The solutions? Understand that money sitting in cash must work harder. Invest in assets that rise with inflation. Broad market ETFs historically return 7% real annually. Move your emergency fund to a high-yield savings account. Set up automatic monthly ETF investing through DCA. Add REIT and real estate exposure. Adjust your retirement calculations upward by at least 1.5 to 2 times. The balance between inflation and your financial well-being is determined by one thing: knowledge and action. Inflation is inevitable. It cannot be stopped, but financial ignorance in the face of inflation is completely optional. You now have the understanding to protect yourself and actually profit from the very economic force that quietly impoverishes those who don't understand it. That knowledge is worth more than any single investment. If this video finally made inflation click for you and gave you a clear action plan to fight back against it, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing and financial concepts this simply, using real experience from over a decade in the markets. In my next video, I'm covering the Roth IRA, which is one of the most powerful tax-advantaged accounts available, especially for young investors. When you combine what you learned today about inflation with the Roth IRA, you'll understand why starting early and growing tax-free is the most powerful combination in personal finance. Drop a comment below and tell me, what has inflation impacted most in your life? Groceries, rent, fuel, something else? I genuinely love reading these responses because they remind all of us that this is real money affecting real lives. Understanding it is the first step to fighting back. Thanks for watching. Remember, inflation is happening whether you understand it or not. The only question is whether it's working against you or for you. See you in the next one.